Most people think they understand supply and demand until they actually watch it play out in real time through the lens of a global geopolitical struggle. Right now, something fascinating and deeply unsettling is unfolding in the silver market. It is a situation that combines hard economics, complex geopolitics, and industrial strategy in ways that challenge every piece of conventional market wisdom. As we speak, silver is trading near $80 per ounce. To the casual observer, that number might seem like just another commodity price spike, but that number alone tells you very little. What truly matters is understanding why we have arrived at this precise moment and what the underlying dynamics suggest about a future that is arriving much faster than the world is prepared for. The modern global economy has quietly become more dependent on silver than at any point in human history. Yet a vast majority of the population still views this metal primarily through the outdated lens of jewelry, silverware, or old coins. This is a dangerous misunderstanding of reality. The truth is that if you were to remove silver from the global supply chain today, entire industries would face immediate and total operational crises. We are not talking about simple slowdowns or minor inconveniences. We are talking about the complete halting of the most critical technologies of the 21st century. Think about the global transition to renewable energy. Every single solar panel being installed from the deserts of Arizona to the rooftops of Shanghai requires silver for its unique electrical properties. At our current scale of production, there is no commercially viable substitute that can match its efficiency and cost. Consider the electric vehicle revolution, which is being forced into existence by government mandates across the globe. An average electric vehicle contains between 25 and 50 grams of silver. This might sound like a small amount until you multiply it by an annual production of 20 million vehicles. Suddenly, you are looking at a requirement of 500 to 1,000 metric tons of annual demand from just one single sector that barely existed 15 years ago. Now, layer on the fact that China, the world's largest consumer and third largest producer of silver, has just moved to tighten its grip. With the release of Regulatory Framework Document number 68 of 2025, Beijing has signaled a fundamental shift in how it views this asset by establishing a strict qualification system for exports for the years 2026 and 2027. They are effectively locking the doors to their domestic supply. This is happening at a time when reported inventories in London are being drained and tied up in investment products like the iShares Silver Trust. We are entering a period where silver is no longer just a precious metal or a speculative play. It has become a strategic frontier. The stage is set for a structural revaluation that could make the previous all-time highs look like a distant memory. The silent crisis is here, and it is paved in silver. In the following sections, we will deconstruct how this perfect storm was built and why the global market is about to face a reckoning that no one can ignore. To understand why the silver market is currently under such immense pressure, we must look at the two giants consuming the global supply at an unprecedented rate: the solar energy industry and the electric vehicle sector. These are no longer just niche markets. They have become the primary engines of silver demand, creating what many analysts call a structural black hole. In 2024, the global solar market reached a staggering 600 gigawatts of new installations. As we move through 2025, that number is projected to climb towards 700 gigawatts. Why is silver so vital for a solar panel? It is because silver possesses the highest electrical and thermal conductivity of any metal. In a solar cell, silver paste is used to print the conductive fingers and bus bars that collect the electrons generated when sunlight hits the silicon. Without silver, the efficiency of the energy collection drops significantly, making the panels far less viable. While the industry has been working on thrifting, a process of using less silver per cell, the sheer volume of global installations is outstripping these technical savings. We are seeing a shift toward high-efficiency cell architectures like TOPCon and heterojunction technology. These advanced designs actually require more silver loading than older models. By 2026, it is estimated that the solar sector alone could consume over 260 million ounces of silver annually, a figure that represents nearly 25% of total global mine production. The story in the automotive industry is equally dramatic. A traditional internal combustion engine vehicle uses approximately 15 to 28 grams of silver, mostly in basic electrical contacts and switches. However, a battery electric vehicle is a different beast entirely. An average electric vehicle requires between 25 and 50 grams of silver. It is found in everything from the battery management systems and power electronics to the complex sensor arrays required for automated driving. As global electric vehicle sales are projected to reach 22 million units in 2025, the automotive sector's appetite for silver is nearing 90 million ounces per year. Governments are not just encouraging this shift, they are mandating it through strict policy deadlines. This creates a non-discretionary demand. A car manufacturer cannot simply decide to stop using silver if the price rises to $100 per ounce. They must secure the metal to keep their production lines moving. What makes this situation particularly dangerous for the market is that silver represents only a tiny fraction of the total cost of a solar panel or a luxury electric vehicle. A manufacturer might see their silver cost double, but that only adds a few dollars to a multi-thousand-dollar product. This means industrial buyers are extremely price insensitive. They will pay almost any price to ensure they have the physical metal needed to complete their products. We are witnessing the birth of a market where industrial necessity is decoupled from speculative pricing, and that is a recipe for a vertical move in value. One of the most dangerous misunderstandings in the commodity markets is the assumption that high prices will always lead to an immediate increase in supply. While this might be true for wheat or even shale oil, silver operates under a completely different set of physical and economic constraints. This is known as supply inelasticity, and it is the primary reason why the current silver squeeze could last far longer than anyone expects. To understand this, we must look at where silver actually comes from. Approximately 70% of global silver production is not the result of silver mining at all. Instead, it is a byproduct of mining for base metals, primarily copper, lead, and zinc. This creates a bizarre and rigid market dynamic. Imagine you are a CEO of a massive copper mine in Chile. Copper prices are stagnant, but silver prices have just doubled to $80 per ounce. Under normal market logic, you should produce more silver to capture that profit, but you cannot. To get more silver, you would have to mine and process significantly more copper. If the copper market is oversupplied, increasing your copper output would crash your primary revenue stream. Consequently, you keep your production steady, and the world gets no extra silver, regardless of how high the silver price climbs. This means that the vast majority of the world's silver supply is effectively locked to the economics of other metals. The remaining 30% of supply comes from primary silver mines, where silver is the main product. However, these mines face a different, more permanent challenge: declining ore grades. Data from the United States Geological Survey indicates that average silver ore grades have fallen by approximately 30% over the last decade. Miners today are forced to dig deeper and process much larger volumes of rock just to extract the same amount of silver that was easily accessible 20 years ago. This physical degradation of the resource base naturally leads to higher all-in sustaining costs, AISC. Furthermore, the timeline to bring a new silver mine from discovery to production has stretched to an average of 15 to 20 years. Between environmental permitting, securing multi-billion-dollar financing, and building infrastructure in increasingly remote locations, there is no quick fix for a silver shortage. We are currently living through the consequences of a decade of underinvestment in exploration. In 2025, global mine production is projected to remain virtually flat at around 813 million ounces, while industrial demand is hitting new all-time records. This is not a temporary mismatch. It is a physical ceiling. When you have a market where demand is exploding and supply is physically unable to respond to price signals, you have the perfect conditions for a parabolic price move. The world is finally realizing that you cannot print silver, and you certainly cannot mine it faster just because you want it. To understand why the global silver market is in a state of high alert, we must look at a single piece of paper issued in Beijing, Announcement Number 68 of 2025. On October 26, 2025, China's Ministry of Commerce, known as MOFCOM, released a regulatory framework that fundamentally alters the flow of strategic metals for the period of 2026 and 2027. This is not a mere administrative update. It is a calculated move to prioritize domestic industrial dominance over global market liquidity. Starting January 1, 2026, China will implement a rigorous export licensing regime for silver. Under these new rules, silver is no longer a freely traded commodity. Instead, it is classified alongside critical materials like tungsten and antimony. For a Chinese company to export silver, it must now meet extreme qualifications. First, a new applicant must prove a domestic production threshold of at least 80 metric tons annually. In some western regions of China, this threshold is slightly lower at 40 tons, but the message is clear. Only the largest, most compliant, and state-integrated producers will have the right to send silver abroad. Furthermore, these companies must demonstrate consistent export performance from the years 2022 through 2024 and hold significant credit lines, often exceeding $30 million. By setting these bars so high, Beijing is effectively eliminating small and medium-sized traders from the international market. This centralizes control in the hands of a few state-sanctioned entities, giving the Chinese government a kill switch over a significant portion of the world's refined silver supply. But why now? China currently controls approximately 60 to 70% of the world's refined silver capacity. They are the factory of the world for solar panels, manufacturing 80% of global supply. They lead the world in electric vehicle production and battery technology. From Beijing's perspective, exporting silver is the equivalent of exporting their own industrial future. By restricting the flow of silver to the West, they ensure that their domestic manufacturers, the ones building the solar panels and EVs of tomorrow, have access to cheap, abundant raw materials while their international competitors face skyrocketing costs and supply uncertainty. This is a classic example of resource nationalism. We saw this playbook before with gallium and germanium in 2023. By the end of 2025, global silver inventories have already plummeted by 70% since 2020. Now, with Document 68, China has officially weaponized the silver supply chain. For manufacturers in North America and Europe, the era of easy silver is over. They are now facing a reality where their primary source of a critical metal can be turned off with a single signature from a ministry official in Beijing. While China is tightening its grip on production, the secondary front of this silver war is being fought in the vaults of the London Bullion Market Association, or the LBMA. For decades, London has been the physical hub of the global silver trade, a place where institutional investors and industrial buyers turn to for physical delivery. However, the data emerging at the end of 2025 reveals a terrifying reality for anyone who needs physical metal. The reported silver inventories in London have entered a state of terminal decline, and what remains is largely an illusion of availability. As of November 30, 2025, total silver held in London vaults stood at approximately 27,870 metric tons. At first glance, this seems like a significant buffer, but once you peel back the layers of ownership, the picture changes dramatically. The iShares Silver Trust, commonly known by its ticker symbol SLV, holds roughly 16,500 metric tons. This means that a single investment vehicle, designed for retail and institutional traders to gain price exposure, now controls nearly 60% of the reported London silver supply. This creates what analysts call the London inventory trap. When silver is held within the SLV trust, it is technically off the market for industrial use. It is legally allocated to the shareholders of the fund. For a solar panel manufacturer or an electric vehicle company to get that metal, they would have to drive the price high enough to convince thousands of individual and institutional investors to sell their shares and effectively unlock the physical bars from the vault. Furthermore, we must account for other exchange-traded products, private wealth management accounts, and metal already committed to long-term industrial contracts. When you subtract these encumbered ounces, the truly available, unallocated silver in London, the metal that can be bought at the spot price for immediate delivery, is estimated to be at its lowest level in over 20 years. The futures markets are reflecting this stress. Historically, over 95% of silver futures contracts were settled in cash, meaning traders just wanted to bet on the price. But in late 2025, the percentage of traders standing for physical delivery has spiked. Industrial users, sensing the coming shortage from China, are no longer content with a paper promise. They want the physical bars in their own warehouses. This run on the bank for physical silver is putting immense pressure on the warehouses. If this trend continues, we could reach a breaking point where the LBMA is forced to admit that the metal available at current prices simply does not exist. The trap is closing, and those who do not hold the physical metal in their own hands may soon find that their paper contracts are worth far less than the silver they were supposed to represent. While the green energy transition has been the primary narrative for silver over the last decade, a new and even more intense source of demand has emerged in 2025: the explosion of artificial intelligence and hyperscale data centers. This represents the third wave of silver demand, following solar energy and electric vehicles. What makes this sector particularly critical is that AI hardware requires a level of performance that only silver can provide, making it an irreplaceable component in the race for computational supremacy. To understand the scale of this demand, we must look at the infrastructure required to train and run large-scale AI models. The global data center server market is projected to nearly quintuple from $204 billion in 2024 to almost $1 trillion by 2030. Each of these high-performance servers is packed with advanced semiconductors, graphics processing units, and tensor processing units. Silver is used extensively in the packaging of these chips and in the high-frequency interconnects that allow data to move at lightning speeds. In fact, an AI server can require 2 to 3 times more silver than a traditional data center server due to its complex cooling needs and superior signal integrity requirements. By the end of 2025, global IT power capacity has increased by over 50 times since the year 2000, reaching nearly 50 gigawatts. This massive build-out of physical hardware has led to a structural shift in silver consumption. In 2024 alone, semiconductor packaging for AI-related electronics consumed between 1,200 and 1,500 metric tons of silver. As we move into 2026, analysts project that global silver demand for AI electronics will rise by another 8%, further tightening an already deficit-ridden market. Beyond the chips themselves, the energy required to power these AI factories is creating a secondary demand loop for silver. Because AI data centers consume as much electricity as small cities, operators are increasingly turning to dedicated solar farms to provide reliable green power. In the United States, data centers have chosen solar energy 5 times more often than nuclear options over the past year. This means that every new AI data center built by companies like Microsoft, Amazon, or Google indirectly triggers a massive new order for silver-heavy solar panels. We are witnessing a convergence where the digital world and the physical world are competing for the same finite resource. Silicon Valley's thirst for AI power is now directly competing with the global automotive industry and the renewable energy sector. For the silver market, this is a force multiplier effect. Even if one sector slows down, the others are accelerating so rapidly that the total demand remains on an exponential path. The AI revolution is not just about software, it is a physical transformation of the global infrastructure, and that transformation is being built on a foundation of silver. When silver prices reach historic levels, the financial world inevitably looks back to the most famous episode in commodity history: the attempt by the Hunt brothers to corner the market in 1980. Nelson Bunker Hunt and Herbert Hunt, sons of an oil tycoon, managed to amass approximately 1/3 of the world's privately held silver supply. Their aggressive buying pushed prices from under $2 in the early 1970s to an intraday peak of $54.50 in January 1980. For decades, this Hunt brothers ceiling stood as the ultimate symbol of a speculative bubble. However, as we look at the silver market in 2025, the comparison to 1980 reveals more differences than similarities. The 1980 rally was driven almost entirely by financial speculation and the use of extreme leverage. The Hunt brothers were not using silver to build solar panels or electric vehicles. They were hoarding it as a hedge against hyperinflation. When the regulators at the COMEX and the Chicago Board of Trade abruptly changed the rules, raising margin requirements and restricting new long positions, the Hunt's house of cards collapsed. On Silver Thursday, March 27, 1980, the price of silver plummeted by over 50% in just 4 days, leading to the brothers' eventual bankruptcy. In contrast, the rally of 2025 is built on a foundation of industrial reality. In 1980, industry accounted for only about 30% of silver consumption. Today, that figure has doubled to over 60%. We are no longer dealing with 2 billionaire brothers trying to corner a market. We are dealing with thousands of global corporations and sovereign states competing for a finite physical resource. The data shows that while the nominal price has reached $79.30, we are still far from the inflation-adjusted peak of 1980, which would be equivalent to approximately $170 in today's currency. Furthermore, in 1980, the silver warehouses were full. The crisis was caused by paper leverage. Today, the warehouses at the LBMA and COMEX are being drained to their lowest levels in decades. In 1980, the world had a surplus of silver. In 2025, the Silver Institute reports the fifth consecutive year of structural deficit. The ghost of the Hunt brothers still haunts the silver pits, but the monster we face today is different. This is not a speculative bubble that can be popped by a simple change in exchange rules. You can change the margin requirements, but you cannot change the laws of physics that require silver for a solar cell. The Hunt brothers ceiling of $50 has been shattered not by greed, but by the undeniable necessity of the modern industrial age. While the fundamental story of silver is built on industrial demand and geopolitical shifts, the price action on the charts is what dictates the timing and velocity of the next move. As of late 2025, silver has achieved a historic technical breakout that has fundamentally changed the market structure. For over a decade, the $50 level, the twin peaks of 1980 and 2011, acted as a nearly impenetrable ceiling. By crossing this threshold decisively, silver has converted decades of resistance into a new powerful support floor. Currently trading near $79.30, the next major psychological milestones are $85, $90, and the ultimate target of $100. Technical analysts use measured move calculations based on the size of the previous consolidation base. This methodology suggests that once the $50 level was cleared, a secondary acceleration phase toward the $85 to $95 range was mathematically probable. One of the most striking indicators in the current rally is the Relative Strength Index, or RSI. Typically, an RSI reading above 70 indicates that an asset is overbought and due for a correction. However, in late 2025, silver's RSI has frequently touched the high 80s. In a normal market, this would be a sell signal. But in a parabolic phase, extreme RSI readings can persist for weeks or even months as momentum takes over. This reflects strong hands buying industrial consumers and institutional funds who are not looking at the chart, but are instead focused on securing physical metal at any cost. Furthermore, the gold to silver ratio, a key metric for relative value, is finally beginning to compress. For years, the ratio hovered between 80 to 1 and 100 to 1, meaning it took 80 ounces of silver to buy 1 ounce of gold. Historically, in major bull markets, this ratio tends to move toward 30 to 1 or even 15 to 1. If gold remains near its current record levels, a return to a 30 to 1 ratio would imply a silver price well north of $100. Traders are also closely watching the volume-weighted average price in Bollinger Bands. The widening of the bands indicates a massive increase in volatility. While this means sharp pullbacks of 5 to 10% are possible, the primary trend remains aggressively bullish. The technical foundation suggests that the path to $100 is no longer a question of if, but when. The momentum is not random. It is the visual representation of a global scramble for a diminishing resource. The astronomical rise of silver to nearly $80 per ounce cannot be viewed in a vacuum. It is a symptom of a much larger shift in the global macroeconomic landscape. For the past several decades, the world operated under a regime of low inflation and a dominant United States dollar. However, by 2025, the foundations of this system are being tested. Silver, often called the poor man's gold, is reclaiming its role as a primary barometer for monetary stability and purchasing power. The first major factor is the persistent nature of global inflation. While central banks have attempted to cool economies with higher interest rates, the structural costs of the green energy transition and the AI revolution are inherently inflationary. We are moving from an era of cheap, abundant energy and materials to an era of expensive, scarce resources. As silver prices climb, they contribute to a feedback loop of rising industrial costs. When a critical component like silver becomes 4 times more expensive, that cost eventually flows through to the price of solar panels, electronics, and electric vehicles, further embedding inflation into the global supply chain. Simultaneously, the world is witnessing a significant trend toward de-dollarization. As nations like China, Russia, and the BRICS Plus bloc seek to reduce their reliance on the United States dollar, they are increasingly turning to hard assets. Silver serves as a perfect strategic reserve because it possesses both monetary value and essential industrial utility. Unlike a fiat currency, which can be printed in infinite quantities, the global stock of silver is finite and physically constrained. When the United States Federal Reserve faces the dilemma of choosing between fighting inflation or preventing a recession, market participants often turn to silver as a hard money hedge against currency debasement. Furthermore, the relationship between real interest rates and precious metals has reached a critical juncture. Historically, high interest rates were bad for silver because it pays no dividend or interest. But in the current environment, the fear of supply shortages and geopolitical instability is outweighing the allure of yield. Investors are realizing that holding a 10-year bond yielding 5% is less attractive than holding a physical metal that has appreciated by over 100% in a single year. We are entering a period where the global monetary system is shifting from one based on debt and promises to one based on tangible, strategic commodities. Silver is at the heart of this transition. It is the intersection where the old world of monetary value meets the new world of high technology. If the United States dollar continues to face pressure from rising deficits and geopolitical shifts, the move toward $80, $90, or even $100 silver will not just be a price rally. It will be a reflection of a new global economic order. As we stand at the end of 2025, the silver market has officially transitioned from a quiet commodity to a central pillar of global economic security. With the price having recently breached the $80 mark for the first time in history, we are no longer speculating about a future squeeze. We are living through it. The convergence of China's export restrictions, a fifth consecutive year of structural supply deficits, and the insatiable demand from the AI and green energy sectors has created a new normal for the white metal. For the strategic investor, the playbook for 2026 and beyond must prioritize physicality and risk management. As the disconnect between paper silver on the COMEX and actual available physical metal in vaults like the LBMA grows, the importance of holding the underlying asset without counterparty risk cannot be overstated. While major banks like Bank of America forecast an average price of $65 for 2026, a significant majority of retail investors, nearly 57%, are now eyeing the psychological $100 milestone. This divergence in sentiment suggests that while volatility will remain extreme, the floor for silver has moved permanently higher. Industrial consumers face an even more urgent challenge. Reliability of supply has now superseded price as the primary concern. Manufacturers are no longer just buyers, they are becoming strategic stockpilers. We are likely to see more long-term offtake agreements and direct investments into mining projects as companies like Tesla or solar giants seek to bypass the increasingly restricted spot markets. The era of just-in-time silver delivery is being replaced by just-in-case inventory management. In conclusion, silver in 2025 is providing a real-time lesson in the fragility of modern global supply chains. It reminds us that you cannot build a digital, electrified future on a foundation of paper promises. You need the physical atoms. Whether you view current prices as a peak or a launching pad depends on your belief in the speed of the technological transition. But one fact remains undeniable. The world has never needed silver more than it does today, and the world has never had less of it available. As the gates to China's supply officially tighten on January 1st, 2026, the real test of global resilience begins. The question is no longer how much silver is worth, but who will be left holding it when the music stops.